Okay, good. All right, welcome everybody. This is the second version we've done of this on this channel, and in the past I've given this probably for the last 3 years on various programs, and I decided to now bring it to this because I thought there's some content here that I thought would help people. And so just a little bit about my background. I think planning and preparation is really important. And I think as you get into learning about the approach that I like to use and that I encourage people to use, is there's a lot of planning and preparation that should go into it. My background is I've managed 3 funds, 50 plus investments out of those funds and others. Before that, I was a partner at Downer & Company, which was a transatlantic M&A firm with an office in Boston and Paris. Equifax Research, I was president of that for 5 years. That was a division of Equifax. And we made 3 acquisitions, and we did a lot of corporate planning. And we also developed the country's first AI underwriting system, which was sold to a major insurer. Before that, I was with Arthur D. Little in consulting. Loved it, great company. And then before that, General Electric in their manufacturing management program. And that's my education. Okay. Some of you are, in fact, entrepreneurs. Some of you are certainly consultants or advisors to entrepreneurs. And what I tell them is don't quit your day job. We all know that things take longer, things move slower. And so I tell entrepreneurs to bootstrap as long as possible. I had a young associate working for me in my last fund, and he was there for about 4 years, 5 years. And then he came into my office one day and he said, Andy, it's been great, had a nice time, but I'm off and I'm leaving the firm. And I said, well, Jesus, David, what's going on? What's happened? Did you enjoy it? He said, I loved it, learned a lot, but it's time. I've got a company that I've been working on weekends and evenings, and I just won a $50,000 prize from a group that in New Hampshire that puts on an event. And so I'm off to the races. And 5 years later, David is doing really well. He's got about 25 people working for him. His product is sold to universities and colleges. He's got 150, 160 of them that are his customers, and he's doing just great. But he bootstrapped as long as possible, and I don't know how many hours he put in on weekends and evenings. He wasn't married, so that probably is good, because he probably would have, that would have been some pressure. I tell people also conserve your equity early when it is the most dilutive. If you raise very much money early, it's going to be at your lowest valuation, and you're just going to dilute your equity. And one company I'm working with, the founder has raised about $1 million, $1.1 million, and he's down to about 35% equity in the company that he founded. And I told him, I said, you know, that's too low. And I said, you're going to have a problem raising institutional money, because they want to know that you are fully committed and that the reward will be material to you. And so that's another reason I think you want to conserve your equity. You want to recruit people that will work days as well, or work nights and weekends, and will work for equity or stock options. That again conserves cash. It is dilutive, but you make a fair deal with them, and you get one shot at your parents and your relatives. From that point on, they're going to, Thanksgiving will be tough, because they're going to look at you and they will say something like, when are you going to pay me back? And now you've got to explain it's equity, it's not a loan. And they didn't understand that. And, you only get one shot at your parents, but your parents are very supportive. The company I was just describing a minute ago, where the owner, the founder, was down to 35%, his parents offered to take out a second loan on their home and give him the $250,000 and just loan it to him. And had anyone else done it, they would have taken equity and that would have diluted them further. But I'm not even in favor of that. And I cautioned him. I said, look, think real hard because that's a big number. To ask your parent for 25 or 50,000, I think is okay, but 250,000 on top of what they had already invested, I think that's going to create some tension. So planning is really important, and this is something that people miss out on. Planning the fund, you should plan the fundraising as thoroughly as you do your product planning, your customer sourcing, and your marketing and sales strategy. And all too often, people think that all they need to do is put a really good and a classy slide deck together and hit the road, and they'll raise money. And not so. That's probably the easiest step that they will have to go through. And most people screw that up too. So one thing I look at is, can the funding be staged? So many companies are looking for $5 million or $3 million, and they're not even generating revenue. Why don't they crawl before they walk and raise maybe just, $500,000, $750,000, and then with that progress, raise more money? One strategy which I'm recommending to people is to stage the funding and give out rights or warrants which are exercisable. For example, if your first investors are going to put in 500,000 or let's say 750,000, you suggest you include as part of the offering that they will get 2 additional rights to invest, but the valuation will be higher in each case. Or if it's a debt security like convertible debt, the cap would be higher. So the first 500,000 might be at a valuation of 3 million. The second 500,000 would be at a valuation of maybe 7 or 8 million, and the third might be at a valuation of 12 or 15 million. And with somewhere between 6 and 9 months between each, so that with the initial investment, they get 2 additional rights to invest. The nice part about that is you now know who investors that you can go back to, and there's a reasonable chance, if you are meeting your goals and your benchmarks, that they will invest that next tranche, because in a way they paid for it with that first tranche, that first investment that they made. And I'm not saying a single investor investing 500,000. I'm saying each investor, let's say it's a $500,000 round, you might have one investor putting in 25, another putting in 50. Whatever they put in that first round, they get 2 more chances to invest that same amount. And if they let it lapse and they don't exercise that right within the time frame, then you would have the right to first offer it to the other investors, and secondly, you could offer it to an outsider. And this just gives you some visibility to the second and the third tranche, rather than raising too much money in the beginning at a valuation you're not going to be happy with. You want to be very careful in your forecasting. We're going to talk quite a bit about forecasting in a few minutes. And you want to be sure that you have sufficient runway so that you don't run out of money before that next tranche or that next round of fundraising. So this is part of the forecasting process that we'll get into. Does your business require a long development cycle, regulatory approval? Robert, you're looking at that as something that's coming up, and that's very important. And so you need to factor that into your forecast. If there are milestones that you think you can hit, that will be very strong and really help you encourage your investors to re-up on that second and third tranche, or to go out for that next round of capital. Angel investors, there are angel investors. There's a group in Boston that they say, we want to be within 50 miles of Boston. That's it. Another group of angel investors, or an angel investor group, define a 2 or 3 state area that they will invest in, and then some will do it nationally. So your location may be important, and particularly if you are a foreign company, you get some significant issues to look at if you're trying to raise money in the U.S. So it would be helpful to have some connection in the U.S. that can help you reach out to those investors. It's less important post-COVID because all of a sudden people realize that geographic boundaries are not as important as they were. I can recall at an event shortly after COVID came, one of the key topics was from the VC panel is how am I going to, make these decisions? Because I previously always would sit in front of the VC and look at them. We would talk, we would reach agreement, we'd go through the term sheet and so forth. Now I can't do that. I don't know if I can do that over Zoom. Well, VC community learned very quickly they not only can do it over Zoom, but they had their strongest year last year, predominantly over Zoom. In many cases, they never even met with the company or the founders. So I think we're in a different world right now. The funding requirement that you need and subsequent fundings, we're going to talk about that in our forecast, so I won't get into that now. Are you a successful serial entrepreneur? Have you done this before? That's really helpful. That's really key, because if you are in fact a serial entrepreneur, that gives you a real leg up. There's a fellow who shared some office space. He was in our office suite, and he had two prior companies that he had launched, and he was simply going back to those investors, and they wrote out checks. One was an institutional investor, not a problem. He had a track record. What if you've actually failed in a prior venture? That's okay, because the reality is, you've got a lot of 20-somethings out there, smiley, sparkling faced 20-somethings that are coming out with some really neat and cool ventures, but they've never failed. And if you have failed in the past, you are actually a lower risk than somebody who has never failed. You've been burned, you felt the pain, you tried to retrench, you tried to pivot, it didn't work, but you learned a lot. You are a better investor, better investment than the first time entrepreneur. Is your product complex? Is it easily understood, or is it highly technical? And we'll talk a little bit more about this, because slide decks, frequently the entrepreneur, the founder, creates a very complex slide deck that illustrates all of the facets of the business or of the product or service. And they're very complex slides. And look, in a slide presentation, people can only sit for so long. And if you've got complex slides that, quite frankly, you usually can't even see, that's a real turnoff. Keep your slides simple, focused, and focus on developing a connection with your audience. And that's something else we're going to talk about. That's the key to presenting. And lastly, are you, well, two things. Is your product, is it understood? Yes. If it's highly technical, you've got to find a way to explain it better. And lastly, on this slide, are you fulfilling a want or need? If it's a want, that's a tough sell. But you can sometimes take a want and define it in the way that it becomes a need. One of the companies that I'm advising right now has a very interesting video product. It's a multi-view product. And I thought long and hard, what is the need there? So it's a better viewing experience. Okay, but is that something that the consumer wants, or is it something the consumer needs? Well, the reality is the need doesn't exist with the viewer of this product. The need exists with the studios, with the producers of entertainment, sports entertainment, musical entertainment. If they can't capture their audience, they lose jobs, they lose opportunity, they lose money. So that's where the need is. And those are also the ones that are paying for it, the studios, the producers, and so forth. So we were able to define the need that existed not with the consumer, but with the professional firms, the producers, et cetera. So you want to somehow define it so that it's clear that it's a need. this is an easy one. You save cash if you can pay with stock options or whatever. But you have to be careful. There may be payroll tax requirements if you're paying with stock. If you're not paying people, there are some issues there that you have to be very careful with. Talk to your attorney. Also, spouses frequently they want cash. They're not impressed with stock certificates that you bring home. I can recall, I think it was my second job. We actually get paid with stock, and finally the company was acquired, but it was not acquired for a lot of money, and I can't remember what I would have gotten for it, but I stubbornly held on to that stock certificate. I thought that would have some value. I don't know, I could probably dig it out at some place, and the company still exists, and the company that bought them still exists, but who knows? Spouses or people that are somewhat naive, as I was back then, they are not impressed, usually not impressed with paper, and they want cash. On the other hand, salespeople are motivated. They are motivated by cash, but if you do pay them with cash, pay them quarterly, not annually. They really want to see that reward and that incentive on a frequent enough basis so that they get that rush. Issuing stock can quickly dilute the founders, as that early example that I gave you, where the founder was down to about 35%. Stock options may be more efficient to use. Discuss this with your accountant and your attorney. But owning stock makes everyone feel part of the team. So there's some companies which I've talked to that after 2, 3, 4 years, the founder still owns 100% of the stock. And people are still working there, but I don't think they have the same feeling towards the company as if they had a few shares. And so you give an employee 100,000 shares out of maybe 10 million that you capitalize the company at. He feels 100,000 shares. That's terrific, but it's only 1% of the company. So you're not giving up a lot. So I think owning stock is a more democratic approach, but it also makes people feel part of the team and that it's worthwhile working nights and weekends. This is getting to some really important sections here that I think most companies do not do. You want to seek outside validation of your idea. In many cases, and Robert, I know you're dealing with this and you're seeking validation with people that are trying these specific, I don't want to call it a drug, but let's say whatever. And they are finding that they're validating it. And I looked at that interview of my friend who you actually sent it to, and indeed, she is finding some real benefits from it. And by the way, this is long COVID we're talking about. So this is really important, and I think a great opportunity. And so they're seeking validation. In that case, you're seeking validation on a extemporaneous basis, but not in a clinical trial. But the next step is a clinical trial. But this sort of is the pre-clinical trial step that I think gives you validation. Another company that I looked at and invested in, our third fund invested in, I met a technology guy. He was a chemistry expert, and I met him at an event, and he knew me a little bit, what I was doing, and described the company that he had just completed some due diligence work on. And he said, you ought to look at this company. I think they have some real interesting science. So I did. Make a long story short, in about 80 days or 70 days, I and 2 other funds that I brought together, we put $3.5 million into the company, and we got a very nice return out of it. So he was an industry expert that company had paid to review their data, review their idea, and he validated it, and that made the whole process a lot more credible. So if you have to pay $2,000, $5,000, even more to an outside expert, that can be very, very helpful. But you just want to make sure you don't give him stock, that he has a long-term interest in promoting your business. Just tell him to pay him and give you a report, and that you'll use the report, and that's the end of the relationship. You can go back later on if you want to engage him for a longer term assignment for his skill. But initially, you want to make sure that it's objective, he's objective, and that if potential investors want to talk to him, they can do so, and they will ask, do you have any other benefits as a result of the work that you did? Do you own stock? Were you promised stock? Were you given options? Whatever. You want him to say no, no, and no. But he can really become a strengthening element to your story. He could also become an advisor, a technical advisor. And we'll talk a little bit about advisory boards, because I think those are really important to have. Ask him and ask anyone that is looking at your business to sign an NDA, because they're going to be looking at your technology. Okay, here's the truth. An NDA is only as good as your ability to pursue somebody that violates it. And I know instances where large companies have violated the NDA and did so wantonly, and the company just doesn't have the resources to hire the attorneys and pursue a $500,000 or $1 million set of 2 and 3 year of litigation before they can finally give them a cease and desist order. It's just not in the cards. So you still ask them to sign an NDA, because at least people will respect that. People who do sign an NDA often look at the language, and they are concerned about the length of the NDA and some aspects of it. So expect some pushback from them. Venture capitalists, by the way, hate to sign NDAs. So you're not going to have a lot of luck there. At best, they may have their own form of an NDA, which is not as strong as the one you would like, but it's better than nothing. And they do that basically as a palliative, just to, you know, give you comfort so they can look ahead. Most venture capitalists depend upon their integrity and their reputation, and they're not going to do something which violates the confidentiality. They're not going to give your information to a competitor. But on the other hand, if they do have a portfolio company that is potentially a competitor of yours, they may decide not to proceed on that basis, and I've seen that. In other cases, you may want to think twice about how much information you reveal and disclose. On the other hand, they are already educated as to your space, either your market or your technology or both. And they might be willing to work through those details so that you're comfortable and the other portfolio company is comfortable, because there may be some differences, or there may be ways in which the two portfolio companies can work together. Those are delicate relationships to structure, but they can be some of the strongest, and it could help you accelerate. I'll give you another example of an interesting situation like that in a couple of minutes, of a company that got funded. Don't let your passion mislead your judgment. You want to be very clear, and you want to have a clear thinker. Either, bottom line is, your attorney is going to be your clearest thinker, because he's going to question everything you want to do, each decision you're going to make, and he's going to look at the glass half full, half empty side, and you're going to have to persuade him. You are betting the next 5 years of your life when you do this, and you are going to put your marriage to the test, and you are interrupting your career if you were on one career path and you decide to, as my young associate did when he left venture capital to start his business. It would have been harder for him to recover. Let's talk about the type of security. Now, everybody thinks safe notes are the hottest thing since sliced bread. Well, that's if you live on the West Coast. But the reality is, safe notes are not good for the investor. They're great for the company, but they're not really good for the investor. And there's a lot of reasons why, which I'm happy to go into at another time, or maybe some Q&A. But they really, we're seeing pushback. The West Coast still is in love with safe notes, but the East Coast is always much more questioning and challenging, and they're not thrilled with the notion of a safe note. So convertible debt is a better deal. And so you might as well do that. Some people say it's so easy. A safe note is a 1-page, 2-page document. Convertible debt, there's one online that you can download, and I think it's maybe 7 or 8 pages. And the terms aren't quite as good for the company, but it's damn good. And I think that's going to be a lot more acceptable, particularly with the economy getting a little squirrely. Fundraising is getting more difficult. I think you want to go with a security that the investor is more comfortable with. Royalty securities are interesting because they can be non-dilutive or much less dilutive. My last fund, my third fund, was a royalty fund. There are only about 5 or 6 of those in the country. And it's a very interesting security. You could structure them in a variety of ways. And one of the topics I'm going to be speaking about with one of these events, Eventbrite events, will focus just on royalty financing because it is interesting, and I've got a lot of exhibits that show how to structure it. We did 12 royalty deals, and 11 of them had no dilution of the equity. One of them did have dilution, but that was because the company could not, there was no equity raised. And we would have, with our royalty security, which is a debt type of security, we would have been on the bottom, i.e. where the equity holders or the common shareholders are. And so we said, look, we got to have some warrants in addition to our other return, simply because we're taking that equity risk in addition to the royalty risk. And we even told them, look, if you can raise money before closing, a few $100,000 to go underneath us, we won't take any equity. And then they got to closing and they said, well, we haven't been able to raise it. And they said, can we have some more time? And I said, yeah, take an extra 60 days. And I think it was 60 days we gave them. They still couldn't raise it. So we did get some warrants, which gave us a little bit of a kicker. But both ultimately, you want to go with what is common in your industry and at your stage. Now, if you're a very early stage company, then a safe note or convertible debt is appropriate. But if you're later stage, then you're going to find, as one company that we're working with, an investor that we talked to on Monday, they pushed back on the convertible debt and they said, nope, we want to have a priced round, an equity round. And it's not going to be at the valuation that you would like to have for your your convertible debt, your cap. And so, well, that's a good opener. That's fine. We're going to negotiate and we'll see where we end up. I think we'll do better than what he is initially saying. But you can do some negotiating with VCs, by the way. So that'll be a whole nother topic that I'll get into, is term sheets and negotiating strategy. Find a good securities lawyer. This is super important. You can find you can use your general attorney for certain aspects of the fundraising process, but you're asking for trouble. I was once asked to be an expert witness for a situation where the law firm really messed up, and the company failed, and the founders of the company were going after the attorney, and the attorney did screw up. And frankly, it's not terribly uncommon. They don't always screw up that badly, but you really might as well pay the extra cost of a securities attorney, because they do this day in and day out. You wouldn't go to your GP for brain surgery, you would go to a brain surgeon. Well, same thing here, except the reality is the securities lawyers today are extremely busy. So he is going to oversee the work, but he's going to have one of his junior partners working on it, doing probably 80–90% of the work, but he will oversee it. And that junior partner, that's all he does. And they are very good. So their billing rate is lower, quite a bit lower. So the end result is it'll be done faster, and the overall cost may be less than if your general practitioner attorney is doing it. So bite the bullet, find a good securities lawyer. I can't stress that point enough. You should consider all of the funding options as you put your strategy together. We talked a little bit about this, but basically your friends and family, that's your first step. You might raise 25, 50,000, you might raise 100,000. Angel investors are the next step, and there you can raise anywhere from 100,000 to $1 million. This one company, which I'll refer to a couple of times, the company raised $2 million in financing from individual angel investors, high net worth investors, all on convertible debt. And the valuation had no cap. That is, the convertible debt had no cap on the value. And by cap on the value, I mean usually a convertible debt or a safe note has a cap in which usually it says, the language is something like the exercise price will be at a 20% discount, so that when it converts, or the safe note converts, it's discounted by 20%. So if the round is at $6 million valuation, those investors participating in the safe note or the convertible debt would get that 20% discount, or 25%, whatever was agreed upon. So they would get in there at 4.8 million. So that's, in essence, they would get more shares. And that's a nice deal for them. But is it worth the risk that they're taking by coming in early? You'll hear some investors say, I want to be your last investor. I want to write out your last check for the round that you're raising money for. Well, what they're really saying is, after everybody else writes out checks and you've proven to, 5, 10, 15 people or investors that you've got a good story, then I'll come in because I'm relying on their spending the time to make that decision. That's okay. Some people are like that. I've had investors like that. Strategic and corporate investors are a whole new category, or not new, but another category, a very, very important category today. But in approaching them, you really have to look for the fit between you and them that is going to lead them to want to invest in you. And sometimes, in fact, frequently, it can be with a competitor to what you have. We had one company that we invested in, and they came out with an instrument, a medical instrument that would focused on a particular disease. And the existing technology, the existing instrument for that was $100,000 per sales price, and it had to be run by somebody that had a college degree, and it had to be run in an air-conditioned environment. And this company developed an instrument which would do the same thing, but it only cost $25,000, and it could be operated at any climate, did not have to be run in an air-conditioned environment, and somebody with a high school education could operate the equipment. And there were a number of other benefits. And they actually approached this other firm that had the $100,000 instrument, and they were very interested. And they said, okay, we'll invest $3 million. Well, that sounded just great. And the company was thrilled, and they closed on the investment, $3 million investment. But they also had some catches in there. One was that they had to hire a couple of people, engineering people, to basically be on site and work for the company. And they were their employees, but they had to work for the company, be paid by the company. They also had to have the equipment totally redesigned to meet their manufacturing standards. And that was a big problem, because that basically put them out of commission for 2 years while they went through that redesign. The third thing is that they required that all sales would then go through their sales force. Well, that was actually going to be a plus, because the sales force was in place. They understood what the solution was that that product offered, and they felt it would be a terrific move because it was a worldwide distribution channel. To make a long story short, 2.5, 3 years later, the company was out of money. They were just barely getting the instrument into the market. The sales force of the company did not like the equipment, did not want to sell it. And the company finally said, this isn't working. Here, here's your stocks back. We're reversing the transaction. Here you go. And now the company while they got the stock back, which was kind of nice, the negative occurred because they now had to declare that as income. So now they had a serious tax problem. So that's the negative part of a strategic investor. The positive side is they can bring all kinds of benefits, whether it's a sales force, the common technology that they understand, and the opportunity to sell the company to them downstream. So what's the ideal combination? Have some ownership by a strategic investor and some by an institutional investor, sort of the yin and the yang, because they will counteract each other and one will prevent the other from acting inappropriately in a board capacity. For example, the strategic investor might say, well, look, we'd like to acquire the company now. And the financial investor might say, no, we don't think the valuation is going to be high enough. We need to run the company or see the company operate independently for 2 more years. So the yin and the yang could be a very positive counterbalancing force, but yet the strategic investor can bring such tremendous benefits, and they're a natural buyer for the company when it comes time. Venture capital, obviously that's a huge investment opportunity, but you want to know who is investing in your industry. And so there are lots of newsletter services and databases that you can research to find out what transactions are occurring. About 25 years ago, I actually published a family of newsletters on the M&A industry. And one of them, it was quite popular, actually divided all transactions up by industry. So if you wanted to know who was buying in your industry, you could look at it. And it was all, at that time, SIC code was the definition of the industry. It was all organized by SIC code. And you could see what transactions were underway. Whenever there was valuation information published, we put that on there so you could look at the PE multiples or the multiple of sales, so forth and so on. And I sold that company to a very large publishing company. But that's very valuable to know who's investing in your company. If somebody pays $400 million for a company in the industry that you're going into, and that number is, let's say, 18 times sales, don't expect your company to have that kind of valuation because A, you are not a $400 million a year company. B, you don't have an established market. C, D, E, and so forth. There are many reasons why your valuation would be much lower than that. Crowdfunding is becoming very popular. I spoke this morning with somebody about crowdfunding, and she has invested in a number of companies with crowdfunding, not a lot of money, but it's something she enjoys doing. And she said, those are my companies. And so she has that feeling of ownership. And that's great. It's a very democratic, it's a very interesting process that has become a phenomenon. I worry about it though, because there now are probably 9 or 10 platforms, and each one has anywhere from 30 to 200 companies listed on their platform. And where do you start? I mean, you've got to do a lot of work, a lot of research, and even then, you're just not guaranteed that you're going to find a good investment. The valuations tend to be higher. You know, if you are an angel investor and you're negotiating your investment with a company, you have a better chance of, I think, getting a more of a wholesale value than you will a retail valuation. It's also usually done through a broker-dealer, and broker-dealers make a commission. And so they're anxious to see you invest as much as you are allowed to invest, and they want to see a high valuation. I think sometimes that works counter. So here's the inside story about crowdfunding, which I have some inside knowledge of. The average raise, the average closing for one group is about $450,000 per company that they were able to raise through crowdfunding. That's the average of those large transactions that raised 2 million, 3 million, 4 million, of which there are not very many, but also those in which the investment or the money raised was only maybe 10,000, 50,000, 100,000, 200,000, average 450,000. There's a company which I'm very close to, that they've decided, against my advice, to go do crowdfunding, and they expect to raise $5 million and they have no revenue. I mean, give me a break. I don't think that's just not sensible. It's not sane. Again, it's that theory, you have to crawl before you walk, and it just doesn't make sense. Even though they're in a very interesting area, they don't have a management structure, they don't have a management team, they don't have a CEO. They're recruiting a CEO, and they've already, or will shortly be, signing the documents to do crowdfunding. So I think you have to be somewhat skeptical and look at it carefully. And lastly, family offices. These are long-term investors. They're great. They have a different set of motives. They want to make money, of course, but they don't necessarily have a 5-year horizon by which they want to exit. And so I think family offices are interesting, but they're just about as rigorous as your venture capitalists now. They are very savvy, and they want to go through the same due diligence process as well. So look, what do you do if you want to raise money? You may do a combination of 2 or 3 of these and not just stick with one. One of the mistakes that some firms make is they do this in serial fashion. They start with, let's say, friends and family. Well, that's normal. But then they proceed to angel investing, but then they also start to do a crowdfunding option. And then they say, okay, we're going to see how the crowdfunding works, and then we'll look at the other options. And the trouble is, crowdfunding can take you 3 to 4 months to become qualified, because it is a regulated platform, a regulated process. You have to follow Reg CF, and you have to, depending on the size of your funding that you're raising, you have to have an audit, or you have to have financial statements that have been reviewed. If it's smaller than $1 million, but there's a lot of goes into it, and so you could be out 4, 5, 6 months before you realize that crowdfunding is not raising all the money you're looking for. So my recommendation is pursue 2 or 3 of these concurrently. Your textbook form of slide deck says you ought to have a TAM, a SAM, and a SOM. You basically, to tell the potential investor what the total size of the market is, what the serviceable size of the market is, and what is the accessible or obtainable market that is one within your reach. And that the trouble is, a lot of forecasts that are done, that people put together the numbers, they say, if I only get 1% of the SOM, which is a $3 billion market, 1% of it would be $30 million. And I'm in great shape. $30 million is the opportunity that I can get to in year 3. Well, I think that's very faulty reasoning. And so I'm going to be going through the approach that I think works, but you still, I think, have to come up with this classic or textbook analysis, just so that people know what the market is and what you can be working with. So to get there, I'm suggesting 2 types of research. I'm going to talk about secondary research and primary research. Primary research is where you do your own research. And this is going to be the most credible part of your investor pitch. And this will get the investor's attention. I talked with somebody yesterday. I'm part of Mass Challenge as a mentor. And I talked to a fellow, and he said, well, I've done interviews with many companies, 20, 25 companies. And I understand what they're looking for, and I think I haven't. And they tell me what they like, what I'm telling them, and so forth and so forth and so forth. He's getting validation from the one source of information that is the most credible, and that is a potential customer. Even better if it was an actual customer, but a lot of these companies are relatively early stage, and we're talking about potential customers, or a mix of the 2. And if you can come up with statements like this, which I show on this slide, you're going to be a long ways down the path of credibility, because you've talked to people. And you want to have quotes. like such as I love the product that you've described, and in particular, I like the feature that enables me to do such and such. And when you can have anecdotes like that, it's very powerful because the investor now says, okay, you talk to ABC company, you talk to the VP. If he'll let you use his name, give you permission to use his name, that's great. It's even more credible. This really sets the stage for a very credible presentation. So collect the anecdotes about their problems and how it could help. And this will also help you shape your solution around those problems. But you have to be careful because if you talk to 20 potential customers, you may come up with a laundry list of things that they would like to see built into your version that you're going to be releasing, that all of a sudden is going to extend your development time by 6 to 8 months and add $500,000 to the cost. You don't want to let it get out of sight. So you want to prioritize and address or add just those features or things that will make a difference to the majority of people. And then add on things later on as you begin to, you issue additional releases. Interviews are really hard to reach, interviewees. I've done this myself, and I'll tell you, in one case, I had a guy who was the vice president of marketing in a company or sales, I can't remember which. And he said, yeah, I'll talk to you, but it's going to cost you $500. Well, this is when I was in consulting. And I thought about it. And so I called up my client and I said, I'm going to recommend that we pay this to them because they are in the catbird seat in this industry. We will learn so much. I will go down there personally. I will interview. It'll be an hour or two interview. And I just know we're going to get a lot of information out of it. And this is like 22 years ago. So $500 today would be like, let's say $1,000 or $1,500. I don't know whether it went in his pocket or went to the company, but I'll tell you, it was worth every penny, what I learned. So sometimes you can offer a discount on the first units or something that is a benefit. There are other techniques you can do to get people to open up and talk to you. Big point. These interviewees become warm prospects for future sales. So if you 8 months from now launch the product, you call them back and you say, Bill, do you recall we spoke last fall and you were really helpful and we incorporated a number of the features in our first release. And I'd love to talk to you about it and see if this is something you would like to incorporate into your systems and see where we can go. And you will find you've got a warm, receptive prospect as opposed to a cold call. Oh, this also becomes, these prospects also become part of your sales pipeline, which we're going to talk about. Here it is, building a sales pipeline. This is the foundation of a forecast, which makes it a believable forecast. So you list your prospects, even if you haven't contacted them yet, because this tells the investor that are there only 7 or 8 prospects that you have in a particular market that you've identified? Or do you have 25 or 50 or 500? And I think that level of confidence will come across and people will be very interested if you can actually list the names of prospects. And then you want to assign probabilities. And I generally say anyone that you list deserves at least a 1% figure, even if you haven't contacted them, just so that you registered them. But those that you have had conversations with, maybe even you as an interview, and you've determined that there may be probability of their having an interest, you can give them a 10%. But until you have a product that's out there, you've got literature and so forth, you probably shouldn't go much higher than that. If in fact you do have customers and you're in business, then you should come up with a scaling of the probabilities, and you should define what each represents, what 10% means, what 25% means, so you can consistently apply it. Then you can use these probabilities and come up with an expected level of sales. So your raw sales level might show that your company has the possibility in the first year of doing $800,000 in sales if you got 100% of the business that you think you could get. But if you now apply the probabilities, it may only be 300,000, and so forth the second year and the third year. Lots of assumptions go into it. And so you now begin to ask the question, can you make these assumptions and be reasonable and rational about it? Or are you just throwing mud against the wall? I think you can be, this is a reasonable and rational way of forecasting, because now you've identified who you're going to go out after, and you can update this. When you do actually begin marketing, you can actually update this and change the probabilities. You can, as you have conversations with people, and this becomes a living document. And in fact, a sales pipeline should be a living document. Salesforce has made a completely huge business out of it. You can start with an Excel sheet, and that's just fine. And then you can go to many of the other tools that are out there, Hub, Monday, and some of the other tools that I think are pretty good. And a number of them are free until you get to a certain size or number of users. But they're very powerful tools, and they really go a long way with an investor, because it shows you thought this out in the way they want you to think it out, and you're not just throwing numbers against the wall. So let's say, again, you can use initial Excel, or you can use a free CRM tool. I've seen companies do both. And this is an example of an Excel sheet, and this is just fine, I think, for early stage companies to use. And this shows how you could populate it with different companies. And you get with an expected value, you get a gross value, an expected sales value, and you do it by year. And there are lots of ways you can do it, but it just shows and demonstrates that you're thinking the process out. Building the forecast. No. A forecast really does influence an investor, as long as it's supportable and as long as it has detail. And I hate to say it, but most forecasts that I look at, the entrepreneurs they just wing it. And I've given you that example before. Tie it to your sales pipeline, and then it makes sense. Your forecast makes sense. Now, in the second and the third year, it does become very speculative. But if you can show what the logic is, i.e., company A, if we think we're highly confident we can get $100,000 a year from company A, and we think that they will continue and increase that to 200,000 in the second year and 300,000 in the third year, but the probability we're going to drop that down each year. So you're showing that you don't necessarily think that it's a done deal that you get them in the second year and the third year. It shows you've given some thought to it, as long as you have a process. Forecasts are the language that most investors understand. If you hit them up with a lot about your technology, they will be impressed to a point, but the one language they all understand, if they're not, let's say, a pharmacology expert or a chemistry expert or whatever, is usually they understand the numbers side. And so you want to do a good job there, because that's where they're going to really look at you, and they're going to draw a judgment on whether or not you're a good entrepreneur to back. This shows that you're also focused on the business side. Now, most entrepreneurs are more technically inclined, because that's how they developed their product. But if you can show that you also have skill in managing and performing on the business side, that will, and not just the technology, that will be very helpful in strengthening their assessment of you. Because your company, if it's an early stage company, does not have the luxury of having a separate business type or a CFO, perhaps. So you want to demonstrate that you have these capabilities, at least for the first year or two. You can cover those, and then you build out your team. This also shows transparency about the cash needs, and it shows your skill as a CEO to have some balance, even though you may not be as comfortable on the financial side as you are with the technology or the sales side. Learn the language and learn it well. And we're going to talk a little bit more about this in just a second, and how you can do this. Time to get going. Obviously, bootstrapping is one way to do it. Raising money too early is costly. We talked about that. Family and friends, we talked about that. Angel rounds, that's about what you're looking at. I'm having conversations with some angel groups right now. And these are very interesting. There's an organization called GUST, G-U-S-T. You may or may not have heard of it. But I'm working through GUST to reach out to probably 20 angel groups around the country. And I've got meetings set up with 3 or 4 that we're vetting, and they are vetting our particular company that we're working with to get them before their investors. So hopefully in September, we'll be on their schedule to make a presentation to their investors. Consider an incubator. Some incubators invest 25 to 75,000. Almost most of them will also introduce investors who frequently come to presentations that their companies make. There's one group out of Nevada. I don't think it's not Las Vegas, but they actually take an equity stake in the company, and a pretty hefty one. They took 9% of one company, which I think is a high bite. They didn't put any money into it, but they did offer them office space and so forth. I think that's a little abusive. And I don't know if they're delivering much value yet. And so I'm watching that one closely. So you want to be somewhat careful, because some of these incubators, they want you to go through their detailed program, and the money that they put in may have some terms that are a little too favorable to them. But it's again, they have to make money, because not every company they put the time into will materialize and yield the benefit. So look at it carefully. On the other hand, some of them are very good, and they have some very experienced people, and they have some very good investors that they can put you in front of. So you have to assess them and look at a number of them if you have them as an option. The Valley of Death. This is something that a lot of people have confirmed, that first round of funding that you can get from angels, which gives you 750,000, maybe $1 million, you're off to the races. But then, that next round, you need the $1.5 million for that next round. And that's tough, because you're in the valley of death, which is between what angel investors you can generally come up with and what your funds will invest. Your venture funds can't really comfortably invest much less than $3 million. If you think about it, and you go through the economics, if you've got a $300 million fund, and you've got, typically a fund that size might have 7, 8 partners, and each partner can handle about 5 or 6 investments at most. So that's 40 investments, 8 times 5. And 40 investments going into $300,000. That's 330. That's about 12 investments per partner, and that doesn't work. A partner really can't handle effectively more than 6 investments. So how do they solve that problem? They put a higher minimum investment per deal that they look at. And so it's hard to find institutional investors that will do less than $3 million per round. These funds have raised money too easily, and the end result is they just can't make the smaller investments. And then they do their next round of capital raise, as every fund has to do. And they've now got a $600 million fund instead of a $300 million fund. How do they handle it? They either hire 5 more partners, which is not easy to do, and the culture doesn't really work that way, or they make bigger investments. And that's what they do. So they raise the minimum investment to 6 million or 10 million. And That's a big problem. So that's what creates this valley of death. Crowdfunding, we talked quite a bit about that, and so I'm not going to repeat that. You do need 4 or 5 months runway to get there, and some firms are very professional about it, and they want to make sure that you have sufficient runway so that you'll be around by the time you're ready to go onto their platform. They do require, in most cases, a broker-dealer. Some actually have their high net worth investors segregated into another category where they don't have to go through Reg CF, and they can actually get you onto their platform in about a month and a half, 2 months. They charge less for it. You don't have to involve a broker-dealer. One of my clients is doing that now. The jury is out. They're taking much too long to get them on the platform. It's taken 2 months so far. I just think it's negligence on their part not to have done it in about 2 weeks or 3 weeks. So crowdfunding can be expensive all in. It can be very expensive if the raise is not successful. So that's why I tell people pursue multiple paths at the same time. Form an advisory board early. This is really important. You start off with an advisory board with diverse people with diverse experience and so forth. Your board of directors, you can have you and your wife on it, or if you're a young company, or you and a co-founder and so forth. If you have some really good people on your advisory board, they are going to be reluctant to be on your board of directors because the board of directors incurs potential liability. And they could be held responsible personally for unpaid payroll taxes, other decisions. I was on a board of one of the companies we invested in with an angel investor who was the most generous, kind, and considerate investor I've ever worked with in the state of New Hampshire. He was from the state of New Hampshire, and he would invest $25,000 into just about any company, and then he would invest more, 6 figures, into a company that he thought had merit. And so he had done that with this company, and we invested in it, and so he and I were on the board, and he was just a wonderful guy. But the CEO was strange, and we discovered only a few weeks after we made the investment, that most of the employees, 3/4 of the employees, were part of this religious cult, this religious group. Holy shit. Boy, was that a revelation. And we really wondered. And the CEO and the building that we were in, the building was owned by the church, and it was unbelievable. In the end, he was telling the employees, "Don't worry, God will take care of you. We will pay you when we can, if we can, but God will take care of you in the meantime." Employees were losing their houses because they couldn't pay their mortgage. This guy was a scoundrel, and he really led people down the garden path. In the end, the employees found a lawyer who would do it totally on contingency, and he sued the board. And so this other guy and I were both the directors, because the third director was smart. He exited 3 months earlier, and so he was not subject to the lawsuit, but Mort and I were, and Mort passed away in the meantime. So I was the only director standing, but his son had a lot of very, very high integrity, and his son, who also was an attorney, but on the West Coast, said, "I'm not going to let this guy get away with this." So he came to the trial. It was a week-long trial, and the judge really nailed the CEO/founder of the company, as he should have. But that's what happens if you are on a board, and if you're on a board too early, you can be drawn into those situations. I had to stay on the board because I had to protect the interests of our fund and our co-investors that were involved in it. So again, at some point after you've had people on your advisory board for a period of time, you will be able to see whether or not they can add value, and whether they would be good candidates for your board. So it's a great proving ground for them. And it also gives them a relatively risk-free opportunity to get to know you and your company, because they are not subject to to being sued or those other liabilities. You want to seek diversity, women and minorities if possible, a mix of sales, tech, operations, and finance. It's easy to find people that understand the numbers. Be careful. Don't let the early check writers say, okay, but I want a board seat. Board seats are not for sale. You can tell them, look, we don't want you to take that kind of risk. Directors are hard to get rid of. One company we looked at investing had two strategic investors, which is very unusual. They weren't going anywhere because they were waiting for the company to either one of them would buy it or one of them would scoop up the assets if they didn't make it. And you've got to be very careful who you put on your board. Institutional investors do expect 1 to 2 seats. That would be a venture fund, etc. You may aspire to become the next unicorn, but the odds are about 1 in 10,000. So go for it, but good luck. I think if you can get a very nice return for your investors, you've done very well and you've built a very nice business for yourself. One interesting thing, I've had a lot of people that have sold their company and they sell it and they say, now I'm going to start another company. But if I talk to them a year later, they're still looking for that next opportunity. They haven't come up with the idea or they haven't found the company to invest in. One of my partners who could certainly purchase a company and I'm thinking of a company with sales of probably 5 to 25 million. And he's looking for one. He's been looking for 2.5 years. He hasn't found one. And it's tough. Good ideas, good companies are hard to find. So if you have a good company and you have a good idea, hang on to it. I also tell people, don't sell the whole company. Sell a piece of it. Keep a piece of it. One of the companies that I had a 10-year relationship with, and I did a number of things with them, raise money for them, advise them on the sale of the company, help them and fund and help them buy the company back, help them sell the company again, help them do a recapitalization. So we had a very good relationship. But ultimately, the company sold for $95 million to Audax, and which is a large PE fund. And but they didn't sell the key people, the founders, chairman, and the president, and the VP of manufacturing and the CFO. They all kept some shares, and Audax wanted them to. And when we sold the company, probably about 10 years, 12 years ago, for about 95 million, and the company had sales of 42 million. Today, their sales are 350 million, and they're very profitable. And so can you imagine what, with almost a 8 or 9 times multiple of what it was back then, just keeping a few percent of the company, what that few percent is worth. So you get a second bite of the apple if you hang on to the company. And that's what I really strongly recommend. These are some other workshops that I'll be working on, and you'll get a notice of if and when they're presented, probably sometime this fall. That's it. Anybody wants to meet with me, I'm happy to meet with you. Go over what your needs are.